Hey traders, in today's video we'll be going over an institutional trading strategy so that you can trade with the market makers. Let's get started. So the first thing you need to understand for this strategy is that there are two types of traders in the markets. The first type are called retail traders. These are the traders just like you and me who are trading their own account in an attempt to make a profit. Retail traders will trade with relatively small account sizes, and they don't have enough money to move the market on their own. The second type of traders are called institutional traders. These are the traders who often trade other people's money in an attempt to make a large profit. Institutional traders will trade with huge account sizes and extremely large amounts of money, enough money so that they are able to move the markets by themselves. As you can see, both retail traders and institutional traders have distinct characteristics and differences between them. And as retail traders, when we begin to understand how institutional traders view the markets, we can use that knowledge to improve the quality of our trading strategies. So retail traders have an advantage when entering their trades that institutional traders don't, and it's the fact that they can enter their full trade position at whatever price they want to. Whether you want to enter a trade position to the size of $10, $100 or $1,000, you can almost always get that full position into the market at the price you desire. This is because there's enough liquidity available for your trade. But this is where institutional traders run into issues and why they must trade differently to retail traders. Because the problem of available liquidity is something that institutional traders have to keep in mind that retail traders don't. Now, for the people that don't know, liquidity refers to the ease at which we can buy or sell assets at specific prices. Let's say, for example, we have a market trading at $100. If there are lots of buyers waiting to buy when the market drops below $100 and lots of sellers waiting to sell when the market rises above $100, then that market is said to have high liquidity. We can place a trade at almost any price we want, and there will be someone ready to take the opposite side of our trade. If, however, there were not many buyers or sellers at these price points, then that market is said to have low liquidity. If we wanted to trade large amounts of money at one of these price points, there simply would not be enough people to take the other side of our trade. Now put yourself in the shoes of an institutional trader who's trading many millions of dollars at once. What would you do if you knew there wasn't enough liquidity available to fill your order at the price you want? How could you get around this problem? The answer to this question is what allows us to trade on the same side as institutional traders. So whenever a retail trader enters a trade, they will also enter a stop loss, which is a level that if price hits will take you out of the trade. If a trader enters a buy trade, then they will put their stop loss below current price. And if a trader enters a sell trade, then they will put their stop loss above current price. Now, if I place a buy trade and put my stop loss below current price, what exactly does that stop loss do? Well, once the market reaches that stop loss, an order is triggered to close the trade at the current market price. So when you think about it, a stop loss is nothing more than a future market order. Say for example, I opened a $100 buy trade at this point in time and put my stop loss below price. What would happen when price reaches that stop loss? An order to sell $100 at market will be immediately opened, which is how the stop loss is used to close our $100 buy trade. So any area on the chart where there is likely to be a large cluster of stop losses will act as a form of liquidity. And remember how we talked earlier about how institutional traders need large amounts of liquidity in order to place their trades. This means that it's advantageous for these larger traders to move the market to an area where they know a cluster of stop losses will be located, because it acts as a form of guaranteed liquidity for them to place their orders at. So let's go over an example of this in action so we can see how we can profit from this type of market activity. So here we are on a 15-minute chart of the dollar Canadian. This market was moving sideways for a short while before we see a huge amount of momentum come into the market as price shoots down. Then we see a pullback, followed by another attempt from price to move down, which finds support multiple times. So we have a clear level of support coming in here. Now, I want you to imagine that you're an institutional trader and you have a massive buy order that you want to place at the best possible price. What are your options? Of course, you could just start buying at the market price, but you have a very large order to fill, and as you begin to buy, this will cause price to continue higher and higher, and so your average price will get worse and worse. So this won't work, because by the time you've filled your entire order, price will be way up here, and your average price will be somewhere between these two locations. But there is another option. When this level of support started to form, we would have had buyers entering at these locations. And where do you think these buyers would be placing their stop losses? Of course, they'll be placing them just below support. So we now have a situation where a cluster of stop losses are building up at a certain area. And like we talked about earlier, these stop losses are nothing more than orders to sell at the market that were placed there by buyers who entered at support. Now, if we're an institutional trader, this is a perfect situation. We have a very large buy order to fill, and we know that if price goes down and hits this cluster of stop losses, this will cause a bunch of sell orders to come into the market, and we can use the liquidity of all those sell orders to fill our very large buy order. So stepping forward a few more candles, we can see what happens next. This long wick red candle comes down and hits the cluster of stop losses that was sitting below support. And all of the large institutional traders use this opportunity to fill their buy orders, using the triggering of those stop losses as a form of added liquidity. By taking the market down to this area, they were able to fill their buy trades at a very cheap price. Compare this to before, where if they had have just started buying at market, their average entry price would have been way up here. So you can see why it's advantageous for a large trader to move the market to where they know a cluster of stop losses would be located. It provides them with the liquidity they need to get their order off at a very good price. But that leaves the question, how can we take advantage of this market behavior? In this example, there were 3 opportunities for us to place a buy trade, so that we could be on the same side as the institutional traders and take advantage of the strong uptrend that followed. The first opportunity came on the close of this long wick red candle. This is an early entry, so it would carry with it some additional risk compared to the other 2 entries, as of course there is always the chance that price could just continue lower from there. The second opportunity came on the retest of support. This is a slightly later entry, although there is less risk associated with it. So in this example, you would wait for the initial rejection after the triggering of the stop losses. And then you would wait for price to come down and retest the level of support, entering on the close of this green candle. Your stop loss would go just below support, and here's why. If the larger traders have already taken price down to hit the stop losses from earlier, and they've gotten the liquidity they needed to get their buy trades off, then there's no reason for them to bring price back down here again. So because they've already triggered the stop losses, we can get away with putting our own stop loss just below support. The third opportunity is the safest entry out of the 3, but it will result in a later entry. So in this case, you would wait for price to move above the swing high that was created before the stop losses were triggered. We see price move above this swing high here, so now we can look for our buy opportunity. If we connect the highs that this market is forming, we get this nice trend line that we can use to assist with a buy entry. So here we've had price break above the previous swing high, as well as break above the trend line. So when we see price come down to retest the trend line on these smaller candles with the wicks on the end, that would be the perfect time to place our buy trade. As I said, this does result in a later entry, but the trade-off is that we get more confirmation that the market is going to continue in an uptrend afterwards.